everyone. We're here today with Tyler Schwende. He's from Safebridge Financial. He's a mortgage broker that I work with on a regular basis. 8 years of experience, and he's a wealth of knowledge. And I have him here today to talk to us a little bit about the upcoming changes to the mortgage qualifying rates, and what it means to you. So, welcome, Tyler. I guess our first question today is, what are the changes?
Right. Well, thanks for having me first off, David. So the main change here is that we currently have to qualify all mortgages at what's called a stress test rate, which means that even though your rate, you could be getting from your bank and lender, it might be 2%, we have to qualify you at the greater of your rate plus 2% or 4.79%. Right now, that is at 4.79% because most rates are hovering around 2%, if that makes sense. So what's happening now is that the government has mandated that all mortgages now must be stress tested at 5.25%. So that's about a 0.5% jump up in terms of stress test qualifying rate. What that does for borrowing power is about a 4 to 5% reduction depending upon a few different factors. So, after June 1st, you will qualify for 5% less loan amount than you will today.
Gotcha. So in practical sense, clients could lose a little bit of buying power. Is there anything they can do to mitigate this at this time, or?
Absolutely, they can. They can get an accepted offer prior to June 1st to be grandfathered in under the current stress test rate. Or if you're doing a refinance as well or a mortgage transfer, get that approval in place prior to June 1st, because that'll allow you, even though your closing could be 20, 30, 60, 90 days after June 1st, it's getting that agreement or accepted offer in place prior to June 1st. So that's how you can kind of circumvent this up front.
Okay, so anyone who has a signed accepted deal before June 1st, they get grandfathered into it regardless of when their closing date is.
Correct.
Understanding? Great, great. Now, are there any other options out there? I mean, it's a very competitive market, and people are wanting to buy. Is there any other options for them where maybe they can get around this qualifying rate after June 1st?
Absolutely. So, I mean, the first thing is you can mitigate with additional down payments. So maybe your loan amount's being reduced because of this new stress test. Well, you can mitigate by putting more money down to kind of get you back up to what you had originally qualified for. So that's one way to kind of get around that. The second thing might be an increase to income. So you might, get a raise if you have a planned raise in a few months, or you might want to ask the boss now for that raise to help, jump up your qualifying income to help kind of bring you back again to a higher loan amount that you might qualify for. So those are two methods. The third is basically we have some credit unions that will enable you to qualify at your contract rate. So whatever the rate you're given by this credit union is the rate in which your stress test is qualified at. So if that's 2.5%, well, your payments are qualified at 2.5% opposed to that 5.25 new stress test, which, as you can see, would greatly, assist in heightening your purchasing power.
Right, right. And is there any cost associated with those? Or?
Great question. So yes, typically those rates are at about a 0.5% premium on current best market, rates. So, if the average 5-year fixed rate on a conventional or uninsured mortgage is 2.25, you're kind of hovering around that 2.75%, which is still a historically amazing rate. Anything under 3% is really historically amazing. To boost you up. Now, again, to get access to this program, you need at least 20% down, and they are a bit more restrictive with qualifying with these credit unions. So, you might need a higher credit score, or has to be in a certain area, within an hour's say drive of this credit union. So there are some other further caveats to this program, but generally in the GTA, we have access to this program.
Great. So just a quick rundown. The qualifying rate is going to jump from 4.79 to 5.25, and it's going to apply to both insured and uninsured mortgages. So just to be clear on the difference between insured and uninsured, insured mortgages are anything with less than 20% down payment, and uninsured is anything with more than 20% down payment.
That's right. That's right. So insured mortgages are less than 20% down on a purchase, for example, like 5 or 10% down. The uninsured mortgage is anything with 20% down, or you're doing a refinance because you need at least 20% equity in your property to even refinance your home. So that's how those are the difference in terms.
Great. Going back to basics, but it's good to get there. Awesome.
Absolutely.
Well, thank you so much for your time, Tyler. I'm sure that was very informative for lots of people. And if you see this video and you have any more questions, please feel free to reach out to me. I might be able to answer them. I'll put you in touch with Tyler. And I hope you have a great week. Thank you so much.
Thanks, David, for having me.
Take care.